10-year note yields opened the week with a modestly narrower range and continued to trade the range, the one we've been talking about, that 170 to 190 range. Yeah, we've been nudging up towards the upper end of that range as of late. But again, we've got a lot of event risk this week. We've got a lot possibly of events that could happen between now and the middle of the month. And there's basically a lot of waiting and sort of let's get some confirmation before we see the next big move after the jobs report we got last week. So at this point, we are very range bound. I don't anticipate any big knee-jerk reactions pre any of that event risk, which we'll talk about in a second. And if you look at market volatility, historically, we've seen volatility bid higher as we go into these types of weeks where we have a lot of event risk and we have a lot of ahead of year end and a lot of uncertainty. Well, as of the last, I won't even go back the last few years, that hasn't been the case. We've seen volatility actually continue to nosedive ever since the Fed got heavily involved in the bond market. Things really changed in volatility-wise. However, now that we have our first few rate cuts under our belt, and now we're going to likely see our first rate cut skip, volatility's kind of back to floating around again. We saw volatility bid late last week. We've seen it firm up again today. So there is some event risk being priced into what could happen this week, whether it be the Fed or the ECB or the UK elections, which are the three calendar events we have ahead of us. And I think at this point right now, a breakout above 190 or below 170 in either direction will find itself with some momentum. And obviously we don't have that yet. We haven't been through those events yet. But the other overhang outside of the Fed, outside of the ECB, outside of the UK elections is the US-China trade deal. It hasn't gotten done yet. And yes, there are tariffs that are going to be applied as of the 15th. Can they get something done before that or at least shortly after, which would help take away some of the pain of those tariffs? That is yet to be seen. There's been a lot of optimism in the market. You continue to see equities go higher. You continue to see a lot of talk and headline risk out there. But the two things that haven't really changed, the bond market remains very fickle. It's holding its own. It's trading near the middle of that range. Gold refuses to go down. We continue to see gold hold north of 1450. And I think at this point right now, you got to see some proof. You've got to see something, some pen to paper, some handshaking, whatever it is in the China-U.S. trade deal to get things to move. Now, what could happen with the Fed and the ECB this week? They're going to continue to hold off for any further rate cuts or any sort of further dovishness, but they're going to have to give some kind of forecast for Q1. And I think at this point, a lot of that uncertainty may carry over beyond year end. So at this point, we hold the range because of the uncertainties in the bond market, but I don't know if we'll get a whole lot of clarity if the Fed wants to take a step back and say, let's wait and see. We need to then get a China trade deal done soon, or else you could start to see those yields creeping back to the lows, and a trade below 170 probably takes us down to 1.5%. Hopefully that doesn't happen, at least not all at once, but ahead of year end, with all this event risk, the China-U.S. trade deal becomes front and center if everything else goes status quo.